That was a very interesting opinion coming in. But another important voice joins in now. Mark Matthews from Julius Baer and Company joins us now. Thank you so much, Mark, for joining us. First up, give us your views on what's transpired, since Friday. Friday, equity markets worldwide has taken a hit. Asian markets today have seen a deep gash. At these levels, what do you, number one, make of the entire tariff scenario? And number two, would you turn buyers at this level?
First thing I will say is I got it totally wrong because I did not think that the Chinese would reciprocate. They've effectively increased their tariff rate to almost the same as the United States on American imports. And that was really the catalyst for the flash crash on Friday. So if you add Thursday and Friday together, 10.8% decline. Historically, that kind of decline is extremely rare. It only happens in black swan events. There have been 19 of those since the S&P began in 1923. And if you exclude the great crash of 1929, actually in 11 of the 14 times when you had a decline of this magnitude, the S&P was up 12 months later, which is pretty good odds. That's almost 80% chance. So I know it feels like the bottom's falling out from under us, and it really is. But I will just say that there have been plenty of other times that we all can think back on when there was no light at the end of the tunnel. And there was actually, it's just we couldn't see it at the time. So we have no way of knowing what the world will look like 6 months from now, 12 months from now. But I'm just telling you that when you do have that kind of flash crash, history's on your side for the market rising. And by the way, it is too when you look at where we are today in terms of stock market volatility, investor sentiment readings, deviation from the moving averages. So I think that the market is probably still going to go down, but I can't believe that the Americans and the Chinese are going to play this game of chicken for very long because both stand to lose. I think the Chinese now feel they have the stronger deck of cards, and maybe they do, but they actually do rely on a lot of things that they buy from the United States that would be very difficult to source from other places, like soybeans. The only two major soybean producers in the world are Brazil and the United States. About 30% of Chinese soybeans that they consume are from the United States, and the Brazilians can't make any more. They're already maxed out. Integrated circuits, airplanes, jet engines, chemicals. The list is actually quite long of things that the Chinese need from the United States that are going to be a lot more expensive with a 50% tariff. And the same works in reverse for the United States. So my sense is that hopefully common sense will prevail and we will get a recovery. But there has been deep damage. So even if we do have a recovery, I think maybe we could bounce by half of what we've lost, and then we just have to, lick our wounds and build a base because there's no doubt there's been very deep damage to a loss of trust among countries in the world, loss of confidence among businesses and investors.
That heat map should once again come up for our viewers. All 50 Nifty stocks are in the red. Your best performer is in Asian Paints, which is down only about 0.5%, and that's because it's benefiting from the fall in crude prices. Brent, remember, is at $64 per barrel, but all Nifty 50 stocks. And plus, Asian Paints has also been a big casualty of competitive pressures, and it's fallen close to about 30% from its 52-week highs. And that today, with a 0.5% fall, is your best performer. On the way down, in terms of top loser, it's Trent, 17%. Then you've got Tata Steel, Tata Motors, 8-9% gone on these individual stocks. Mark, hi. Morning. You called it a game of chicken between US and China. The question is who blinks first right now. But do you get a sense the way, Trump has been defined in his stance? When asked about the pain in the stock market, he's like, I don't want anything to go down. But sometimes you have to take the medicine. So given this kind of posturing, do you think this uncertainty is likely to be prolonged? He's willing to bear the pain? And what would the next 6 months look like, to your opinion?
I really can't forecast them, and I can't say when either side will pull back. It's just impossible to say. But all I will say is that common sense would have it that they mend fences. And unfortunately, there are many instances throughout the history of humanity when common sense has not prevailed. So I could be wrong, but I do notice that many countries are negotiating with the United States. China's the only one so far to have reciprocated to this degree. And so the longer it stays, with this stance, the more it sort of looks separated from the rest. I don't know. I can't answer the question. Sorry.
Mark, we get that point, complete uncertainty. It's so tough to form an opinion. But once again, what we'll try and do is we'll try and get your take. As far as the Indian markets are concerned, do you feel India, within the emerging market scenario is relatively insulated, given the fact that the effective rate of tariffs for India is lower compared to China, Vietnam, where we compete with in terms of exports to the USA? In that context, how do you view the Indian equity market? Would you turn a buyer at this level?
Well, unfortunately, I can't give you a straight answer. Once again, there's so many moving parts. I mean, on the one hand, the economy is quite well insulated to what's going on in the rest of the world. The collapse in the oil price is good for India, allows the RBI to cut rates more. The foreign ownership of India is at a very low level, so foreigners don't really have a lot of stocks to sell. But I guess what concerns me is it has been a very bullish market over the last 2 years. It did go up about 50% in 2023 and 2024. And to the degree that retail investors start losing money, then it could become a bit of a snowball effect. In other words, if you can imagine a snowball when it's rolling down a hill, starts off small, but the more snow that clings to it, the bigger it gets, the faster it rolls. And so the fact that retail investors are very long the Indian market is somewhat, of a concern. So I'm giving you a whole bunch of different stuff, but I would have said just fundamentally India should do better than the rest because foreigners own not very much of it, and it is an economy that is quite insulated from all of these crazy things going on in the world.
So many things in India's favor, right? Crude prices are down. The dollar index has retreated significantly. India, which had preceded the fall with a 16-20% kind of a decline already seen, valuations today are far more reasonable, 17-18 times on the frontline index. Plus, the budget tax cuts will help consumption in the domestic economy, and relatively, the tariff picture for India should be a lot better. But, Mark, getting back to the point about confidence, a lot of, investors, too, seem to be worried about that. Let me just quickly pull out this tweet that billionaire investor Bill Ackman, who had endorsed Trump during the election, says, as he tweeted, America is heading towards a self-inflicted economic nuclear winter as a result of U.S. President Donald Trump's tariff policy rollout. He says by placing massive and disproportionate tariffs on our friends and enemies alike, and thereby launching a global economic war against the whole world at once, we're in the process of destroying confidence in our country as a trading partner, as a place to do business, and as a market to invest capital. He adds, when markets crash, new investment stops, consumers stop spending money, and businesses have no choice but to curtail investment and fire workers. And it's not that just big companies will suffer. Small and medium-sized businesses and entrepreneurs will experience much greater pain. Almost no business can pass through an overnight massive increase in costs to their customers. And that's true even if they have no debt. And unfortunately, there is a massive amount of leverage in our system.
Well, that's right. Bill Ackman, in fact, goes on to say the president has an opportunity on Monday to call a timeout and have the time to execute on fixing an unfair tariff system. Alternatively, we are heading for a self-induced economic nuclear winter, and we should start hunkering down. May cooler heads prevail. Well, with that, we'll now slip into a quick break. Up next.
Okay, just one more question, Mark. In the past, whenever we've had crisis, and you referred to it at the beginning, that, we've had these flash crashes in the past. There was a, fixed policy response, whether it was to COVID, the government would reflate the economy, even to financial crisis. This time, now that it's government-induced, what could be the kind of policy response that we see? How do you get out of this mess?
One would be from the Federal Reserve, of course, but if the Federal Reserve doesn't want to do that because there's going to be an inflation shock, then I would say the onus has to be on the government to withdraw these tariffs. The billboard that Trump showed in the Rose Garden lawn was just full of all kinds of numbers. It was crazy and complicated and didn't make any sense. And for an economy this size, the largest economy in the world, to recalibrate its trade flows and its supply chain so quickly, it's simply not possible. So something has to happen. I absolutely agree. And my bias would be that they will somehow withdraw these tariffs, and largely through negotiating with other countries to bring them down mutually. It has to happen very quickly. Otherwise, there's no doubt the shock on the economy will take it into a deep recession.
Mark, one question. As far as healthcare and pharma is concerned, we still don't have clarity on the quantum of tariffs that are expected to come in. Now, India, in terms of the actual quantum, doesn't really export too much into the US, but in terms of volumes, it's quite large. Also, there are worries that US may not be able to set up manufacturing of drugs, as quickly as, the tariffs are put into place. In that context, what is it that you anticipate in terms of healthcare and pharma for tariffs that, for exports into the US?
I don't have, I'm sorry, the knowledge to answer that specific question. I just can't. But to the degree that India sells generic drugs into America, then I think those are not the kind of drugs that America deems of strategic importance, that they're talking about developing their own capacity in case, there's some kind of war or something like that. I'm sorry, I don't have much more to add apart from that.
Are you in the camp that believes we're going to see many Fed rate cuts this year, or not? Worried the Fed may not, being worried about the inflation shock?
I suppose that if we have a very deep dive in economic activity, there will be a Fed response. But the problem is that the tariffs are going to be inflationary. And so just looking at an iPhone, for example, the cost of an iPhone should go up about 30% unless the company Apple decides to, reduce its margins dramatically. So there'll be a conundrum for the Federal Reserve because they're going to have a recession and inflation. I guess, if I think back to the last time that happened, it was the early 1980s with Paul Volcker, and what the Fed did was it raised interest rates. It didn't cut them.
Thank you so much, Mark, for joining in, giving us your view on a variety of subjects in this particular developing story as far as tariffs across the world are concerned. Thank you once again. Well, we now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.